Hello, today we're going to be looking at ticker symbol AAPL Apple Inc. And they are currently trading at a price of $193.62. They have a 52-week high in this range, and they're the first company to ever reach a 3 trillion market cap. Their 52-week range is from 124.17 to 198.23. They're trading currently at a PE ratio of 32.87, which is kind of high. I mean, for good businesses, it can always be higher, but typically for a great business like Apple, as long as they're still growing, I would say PE ratio from 25 to 30 is pretty good. As you can see here, they have a 1-year target estimate of 172.86. I'm just using Yahoo here because it gives you a good little preview of what we're looking at here for Apple. You can always come over here too if you want like an analysis, and the analysis is just the analysts that follow it. Like currently the number of analysts following it for this quarter was 29, and then they have their low estimate and then their high and average. But if you come down here and look, they're saying the next 5 years Apple would grow at a 7% rate. The past 5 years they have grown at 23%, but that also is a little skewed because of COVID-19. Businesses like Apple are making a shit ton of money from all the businesses that were getting extra income because people had money to spend. But yeah, so let's go ahead and start looking at their free cash flow numbers, which are really good. Like if you come down here, we can see since 2013, because we want to look at about the last 10 years. So we got 45 billion, 50, 70, 53, 51, 64, 58, and this is where I talk about COVID, where it starts to get a little high. So 73, 92 billion, and then wow, look at that. That's a huge jump, but that's gonna be interesting to look at because as you see here, it's down to 55 billion. But anyways, let's go ahead and take a look at their revenue. We'll keep this page up because we're going to use this for our calculations. But let's go ahead and take a look at their revenue. It's declining. See, March 31st to 2023, the trailing 12 months. That's a decline year over year, and I think they're expected right now. See, they're expected right now about 81 billion, which is a huge, downside from 121, 92 down to 81. So they are declining at the moment, but you couldn't expect them to grow forever. But if you were to go down and look at their revenue for like 2019, 2020, so it's because this is in millions, so it's not too concerning. Apple's a great company. Their net income, go ahead and look at their net income. It's declining a little bit, but if you go down here, you can see how since 2013 it's rose at an extremely high rate. It's starting to settle down because 2020, that's what we were talking about, the COVID years, 57 to 94 billion. That's a huge difference. So we'll see a little slowdown for net income as well. But their shares outstanding, they do a lot of buybacks, which is good. We'll do like a little calculation here just to show you how these declining year over year is good for consumers. We can use these as a rough estimate. Let's go down and see where they're at right now. 15. Okay, so they haven't done any buybacks since. Their operating income, they make money. That's what they do. But assets and liabilities, total assets 332 billion, total liabilities it's currently sitting at 270 billion. So they have a good assets to liabilities ratio. Long-term debt 97 billion. So if you were to take this, we can go over in this calculator. Just your net asset calculator. And then, we'll go in here and just type in these numbers real quick and see what we come up with. So total assets 332 billion. We'll just do a rough estimate. So 332,000. Total liabilities 270. 270,000. And Then you want to go over here to the revenue and profit so you can look at the outstanding shares. We're going to go with the 15,847. 15,847. And let's see what we come up with. So a net value of 3.91 per share, which is good. I mean, obviously it's not how you would value a business like Apple, but it's just good to show you that, currently their assets to liabilities by outstanding total shares is 3.91. But we'll go back here to the free cash flow, and this is where we're going to start looking at these numbers. We could enter it in from 2013 up to here, but I think what we're going to do is we'll just enter in 2020 to 2021, which will give us like a rough estimate. And pretty much if you see 73 billion to 92 billion, around that 81 billion that they're going to be trading for right now. So we'll just enter in these two numbers, since Apple is a business that you would like to pay premium for. And we're going to come over here to our discounted cash flow calculator. We have two of them that we can use because I like to value them different ways and roughly take an average of them. So we'll put in the 2021, we'll put 73365. This is in millions, by the way. And then 92953. Average growth rate, they said 5 years, the analysts, was about 7%. So we can just leave it at 5%. We'll look at that. Average growth rate, we're not worried about that right now. We have a 10% discount rate, perpetuity 2.5%, and then we're going to go to the shares outstanding here. See, 15,847, so 15,847. So then we get a no discounted cash price of about 86.03, but that's with the 5% growth rate. So if we were going to do the 7% over a 10-year span, see we're 99.61 range, so the average free cash flow was about 83,000. As you can see, we're just discounting it to the present level. But another thing I wanted to show you too is look at the difference here. You see how the shares outstanding is like this. So if you come over here, and if we were to do the 17,528, you'll see the big difference. So we'll just do 17,528. See, big difference. So we'll go ahead and do that. Another thing we can do is, actually this is Apple, so we shouldn't do it 10%. Let's just do 8%. Discount rate, go back to the original shares, 15,847. And the reason I don't have this all filled out is going to just kind of show you how to do it. So see 138.99, bull case 125.09. The no discount one is like this is 10%, 20%, 30%. I think this one might be 45%. I'm not sure. I can't remember. At the 40%. Yeah, it's a 40% discount rate. And then we'll go over here to this calculator here. We'll just take 83154 and place it into this last one. Usually you just want an average discount of the free cash flow, but businesses like Apple that are growing all the time, you're not going to get an accurate number doing the low like 40 billion compared to the 90 billion and 83 billion numbers that we're pulling from here, because it's highly unlikely within the next 10 years that Apple's going to see a huge decline in revenue. I don't really see any other businesses that can compete with them besides like Samsung, but they don't ever really cut into their profit margins. So 15,847. So we do, this is a growth rate of, we're going to do the 7%. So we get 126.37, but we're going to do for Apple, we're going to do 8% discount rate. We can get $170.24, but then if you want to do regular discount rates to that, we get 153.22, 15%, 144.70, and 20%, 136.19. The interesting one here about this calculation with the average free cash flow starting out here is that at 144.70, the 15% discount rate, obviously this is way off where they're trading at $190 right now. But Warren Buffett likes to buy Apple at 140 and below. So this is a pretty decent range, and as you can see, as we already talked about, like they were trading at the 120 range. But let's just go down here again and look just to make sure. See, next year 10%, but over the next 5 years, it's estimated to be about 7%, and they're currently declining. But we already know that because COVID was a whole different beast. But if you want to go over here and look at their financials, I like to use microtrends. But if you just want a quick overflow for the last couple of years from Yahoo Finance, they have all this here, including diluted EPS. But yeah, they have all their basic information that you can use. I like to use microtrends. It's free, and they got statistics here like their trailing PE, forward PE, price to sales, price to book, enterprise value revenue. Just some quick things that you can look at here. And income statements, quarterly revenue growth, how many shares they have, shares outstanding, how much is held by insiders, institutions, shares shorted, short ratio, all this stuff you can use for many businesses. And it's just quick and easy to look at, because usually when you type in like Microsoft stock, Yahoo Finance will be one of the first ones on there. You can just click on it. Ex dividend, their last one was May 12th. Dividend date, they paid it on the 18th. Their current payout ratio is 15%. That's really low, so their dividend ain't going to be cut anytime soon. Their average 5-year dividend yield 0.89, and their annual dividend yield forward about 50%. They're saying, but they're always growing their dividend, so that's always a good thing. So we'll also throw Apple into the dividend discount model, which will be a good one to help value them. And let's see, so their current one, we just want to show you what their current dividend is. So what I like to do is I just go AAPL dividend. So you just do this. Currently 0.24 cents every quarter, which is an annual dividend yield, as we already saw on Yahoo. And then, you just come down here to dividend history, and as you can see, 0.205, 0.2222, so going up, they're increasing it. And so 0.24 annual dividend, 0.96. So we're gonna go 0.096. Average growth rate about 5%, 23. How you would do that is like, look, so their last one, 24 minus 23 divided by 24. I didn't put an equal sign. This is some quick math for you guys. This is help you find the percent change. So equals that. Okay, what am I doing here? What a rookie mistake. So 0.24 take away 0.23. This is some rookie stuff, and I'm sorry, but this is a good way for you to find the percentage change on your own without someone there to help you. And then you just divide it by the 0.24, the current number. And then if you were to put this as a percent, you get a 4.17%. So we're going to say a 5% growth rate, discount rate for Apple, 8%. I messed this up here. This is supposed to be 9.6, so 33.60 based upon those numbers. That's just about a dividend discount model, but that's not why you want Apple. They have growth. But if you can see AAPL dividend growth rate, you can go to Seeking Alpha. See, Seeking Alpha. But I'm just showing you just in case you don't know. So our average growth rate over the last 5 years is 7.62%. The last 3 years is 5.93, which is why I went with the 5%. Their current dividend. But that's not an accurate way to value Apple, so it's irrelevant. And then if you were to take their EPS, you can go over here, Apple's, go to their revenue and profit, EPS. We'll just do 6.11. Their trailing 12 months is 5.89. But we'll do the 6.11 just for the Benjamin Graham. 6.11. Growth rate, we're going to do 7%. Corporate bond rate 4%, PE of no growth 7, and then the current price is trading at 190.68, and then this is what you get for Benjamin Graham. But as you can see here, I'm probably going to use either this model, see the no discounted cash flow, no discount, compared to this one, so you have the 15% discount rate. So if I was to value Apple, I would be buying somewhere probably about 125 range, because I like to have a hefty safety range because I'm trying to beat the SPY, and if I'm not trying to beat the SPY, then what am I doing? I might as well just invest in funds. So yeah, there's that. So that we looked here at the NAV 3.91 dividend discount model 33.60. If you were to increase this growth rate, just because it's Apple, we'll say 0.7 growth rate, and then 8% discount 102.92. Another interesting thing is if we were to do the 0.5 rate again, and then we just did a 6% discount rate, we get 180. But for whatever reason, let's just say Apple starts to not use their free cash flow to grow, and they were to keep up with that 10-year, so they were doing 10% and we'll just do a 12% discount rate on this one. 52. That's it, growing at the 10%. If it did 11%, 105. So it just all depends. You just play with numbers. So that's why we're just doing healthy assumptions for ourselves to get an idea. If we were strictly looking for a dividend discount model of growing those and 8% discount rate, then it's not going to work for us. But they have a lot of growth, so that's why I think a discounted cash flow model works best for them. And if you want to load up on Apple when they fall down lower, go ahead, because people are going to pay premium for them. If you go here to like a PE ratio calculator, right? Whoops, I messed that up. Ignore my spelling for a second. So price per share. Right now, we're going to do the 190, and we'll do 6.11 PE ratio of 31.22, right? But currently they're trading at like a 32, so this is just a rough estimate. But if you were to change that, let's say to 35 on the PE ratio, just an example, the $213.85, they still have room to grow. And then if for whatever reason they were trading like Microsoft, in that area, or some other companies, and they went to 40, you see they have room to grow. So it just depends what you're comfortable paying for the PE ratio. But yeah, that's my evaluation currently for Apple. And I hope that you liked this video, and please leave any tips and comments and questions for me. I'm learning, but learning how to do YouTube, but I like evaluating businesses, and I do think Apple is a great stock.